Hi, good evening, friends, and thanks a lot for joining in the call. I hope all of you are doing well, safe, and sound. Very quickly, I'll introduce our today's speakers to you. I'm Saurabh Jain from Union Mutual Fund. I take care of sales and marketing. On the call, we have Mr. G. Pradeep Kumar, our CEO, who, who is an IM Ahmedabad pass out. He has an experience of more than 28 years in the mutual fund and the fund industry. He has worked with organizations like UTI and IDFC prior to joining over here. He has been here with us from the beginning, 2010. Apart from that, he has also served on the AMFI board as vice chairman. Currently, he is also the member of the board for AMFI. We also have Mr. Vinay Pahadia over here on the call, who is our CIO. Vinay joined us in April 2018. Prior to joining us for 10 years, he has worked with Invesco. And before that, he has worked with different organizations like Chola, etc. We also have, on the call, our head of fixed income, Mr. Paijat Agarwal. Paijat Agarwal comes with an experience of more than 24 years. He's an IM Bangalore pass out. He has, prior to joining over here, he has worked with SBI Mutual Fund. He has also worked with State Bank of Mauritius. So without taking much time, friends, over to Mr. G. Pradeep Kumar to give an introduction.
Thank you, Saurabh, and good evening, everybody. Thank you for joining us. We really appreciate your time and interest in joining us, this evening. It's always a pleasure to interact with our distributor friends, and a lot of things have been happening in the market, and we have tried to interact with many of you on a one-on-one basis or in small groups over the last 8-9 months during this lockdown. It's been a learning experience for all of us. I'm sure even for all of you, because this is not something that any of us had seen earlier in our careers, and hopefully we will not see such a thing again in future. But it has taught us many things about our profession, how to handle things, and also about how to handle life in general. Because life is not about mutual funds alone. It's not about work alone. There are bigger things in life which we must keep in mind. So I do hope all of you have been keeping well, safe, and sound along with your families, your colleagues, everybody. At Union Mutual Fund, we have tried our level best to continue to support our investors and our distributors during this difficult time. Only you can say how successful we have been. If there are areas of improvement, we would always be happy to look at it. But it's my belief that my team has really tried their level best to rise to the occasion and continue to service our distribution partners. Now, there is always a question about why an NFO now, why this NFO, etc. But before I get into that, I would like to give you a quick update about what's been happening to the company itself, Union Asset Management Company. As many of you would know, from being known as Union KBC earlier for the last 3 years or so, we are Union Mutual Fund. We are majority sponsored by Union Bank of India, but Daiichi Life of Japan is a significant shareholder and a co-sponsor in our company with nearly 40% stake. This gives tremendous support to our company. Financially, it makes us very strong with a very good balance sheet and net worth position. The presence of a Daiichi executive on our board gives access to Daiichi's system, knowledge base, etc. whenever we need. Importantly, Daiichi has been quite impressed with the investment process that we have adopted, and they have also given us a mandate to manage part of their India allocation. We believe that is a significant stamp of approval and credibility to get a mandate from a large institution like Daiichi. So the reason for that has been the robust investment process that we have adopted over the last 30 months or 32 months, ever since my colleague Vinay Paharia joined us. in April of 2018. We have completely revamped our investment process, not only on equity, but on fixed income side as well. Okay, we have I think legitimately we can claim today that we have one of the best processes in the industry. And the important thing is that we follow the process, because theoretically everybody will have a process. Theoretically, everybody will sound great. The proof of the pudding is in eating. Now, our objective has always been to produce consistently above average performance in every category of funds that we operate in. Okay. So that can happen only with a strong process. Now, the fact that almost all of our funds, both on fixed income and equity, even on the hybrid category, our funds are above average. They are very often in top quartile or second quartile, is a testimony to the investment process that we have been adopting. So if you ask me what sets us apart today, it is the process. It is not a star fund manager. Vinay is present. I'm sure he'll be the first to admit that it is not about Vinay Pahadia. It is not about Parijat. It is not about any individual in the company. But Union Mutual Fund today stands for one of the best investment processes in the business. And we have not deviated from that ever since we adopted that, not even in one case. The beauty of our company is that while we have all the benefits of being part of a public sector bank, the stability it gives, the distribution network it gives, the banking support that we get, etc. Nobody from Union Bank of India interferes in our business. Right from day one, we have been given the mandate to run this business. There is nobody from Union Bank or Daiichi sitting in our company and telling us what to do, what not to do. They have never done that. So if things are good, yes, I think we can legitimately take the credit. If something is not right, I don't think we can blame anybody else. That's our team that is responsible. We get tremendous support from both our sponsors, both Union Bank and Daiichi. But the functioning of the company, the operations of the company, it's our responsibility. As Saurabh said, I have come from the market. Same with, Vinay, Saurabh, Parijat. We all have worked with other reputed mutual funds before joining Union Mutual Fund. And I'm also very happy to say that we have a very stable team. Almost everybody, perhaps other than Vinay, every member of our senior team has been with the company since beginning. So we believe that we have reached an inflection point whereby we have stable sponsors, we have a very stable balance sheet, we are profitable for the last 2 years, and I'm sure we'll continue to be profitable this year also. And most importantly, we have a wonderful investment team, a very robust investment process, which is showing in the performance numbers. So whether you take our balance advantage fund or multi-cap fund or tax saver fund, whichever, all those funds are today producing very good value in the respective categories. And as I've always said, the size may be small. Our thinking is not small. We definitely want to be known as one of the best in the industry. And importantly, one of the most consistent performers in the industry. We do not take, any undue risk. Taking risk is part of the job, because if we don't take any risk, there is no job for us. Our job is to assess the risk, identify what is an acceptable level of risk, and then go with that. Because if no risk is to be taken, people will simply keep money in bank deposits and sleep over it. So that's not what we do. We assess the risk, we manage the risk, and we try to mitigate the risk. So that is there in the performance. And as far as the distribution is concerned, we over the last 3 years have been working very hard to improve our engagement with all of you. I know very well that it's not an easy task. We have been working hard, and I thank all of you for responding positively and supporting us, because it's not easy to support a new AMC or a virtually new AMC. Many of you have done that, and I'm really grateful for that. And I'm sure that our funds and our fund management team will not let you down. The support on the sales side is also important. We have invested in that. So this year, in spite of all the slowdown and COVID-related issues, we went ahead with our decision to create a separate team. We hired extra people, and we created a separate team of nearly 40 people to service the MFD community. So as and when necessary, we'll expand the team, but we are very keen that we provide high quality service to all of you, keep engaging with you, and also keep listening to you, so that any feedback, any constructive feedback from your side, we are able to accept and act on it wherever possible. As far as the product is concerned, I'm not getting into details of this fund, the NFO, which Vinay and Parijat will cover. But I want to say one thing, that it has always been our belief that we will launch a product only if we feel that our investors can make money out of it. We have never been asset gatherers. We have launched funds, and we are launching a fund. And even this fund we are launching now for a reason, because it fits in well with our belief and our view of the market. That is the reason we are launching this fund. So it is not about launching funds just for the heck of it or just to raise money, but it is because we want to complete our product basket, become a full service provider for our distributors and investors, and also because we believe a certain type of product is suitable for the market at this stage. So that's the reason why we are coming up with an NFO. And I don't want to jump the gun and talk in detail about the details of the product and the market view, which Vinay and Parijat are more competent people. But once again, thank you for your support. We are very keen to work with you and do all that we can to increase our engagement and make sure that we deliver top quality service to you. So with that, I will stop now. We will interact again during the Q&A session. Thank you, everyone.
Thank you, Pradeep. Thank you, Pradeep. Yeah, Vinay, before I hand over the mic to you, I was going through the questions. There are more than 200 questions which people have asked. Can I read few of them so you can cover them while giving the view on the market and also about the fund, so that we can answer more questions towards the end. Can I read few of
Sure,
them which you
sure,
can
sure.
cover? Okay, so markets are expensive. The view in the near term on the market. If someone has got lump sum to invest right now, should he do in one go? Should he do STP? What should be the strategy? Would we be deploying everything in the NFO immediately, or we stagger it over 3-6 months? Uh, why hybrid fund right now, and BAF versus hybrid fund? So these were a few questions. If you can cover them in your talk, and the rest we'll take later on. Yeah.
Just a minute. Yeah. Okay. Uh, so thank you, Saurabh. Thank you, Pradeep. Hope I'm audible and visible.
When it's slightly loud, if you can put the mic closer to you, it will be better. Yeah.
Sure. Yeah. Hope this is better.
Yeah, this is
Yeah.
better.
Okay. Okay. Thank you. So a warm welcome to all the participants, and thanks once again for joining us. I will cover two aspects. First is our markets view, and second is a brief about the product. So to start with, I think a lot of questions on the markets and how do we see the markets, etc. So first and foremost, the way we look at markets is also similar to the way we look at individual stocks, which is follow our proprietary fair value approach. So first, a brief about what has happened over the last 9 to 12 months. So if you look at from December 2019 till February 20, we were having business as usual. There was no big uh, uh, worry about the pandemic, etc., despite the fact that it was already spreading fast. However, from February 20 onwards, there was a sharp deterioration in sentiment and the pandemic, and we saw a big worry in the markets. By March, we were already grappling with a substantial rise in and worsening of the pandemic. So we were not only worried about what its impact on the economy, but we were also worried about our own lives. So there were expectations of massive lockdowns. There were expectations of change in demand patterns, job losses, fall in income for most of the people, impact on SME, etc. So a lot of questions were there, but we were grappling with many of the answers which we did not have then, and hence there was high level of uncertainty by March. Gradually, as the pandemic progressed, as we have seen a gradual improvements over the last 6 to 9 months, the markets also have started assessing the impact. There is much more clarity about the impact. Most of the global agencies and professional economists estimate the impact for Indian economy at about 12%. And even our own assessment of the impact of Nifty's fair value is approximately 10%. So based on that, the overall impact of this pandemic is a cut of 10% in fair value of Nifty as it was estimated about a year back. Having said all of that, so all of this is past. What now? We are seeing markets at close to their lifetime highs, and a lot of investors are worried whether this is there a bubble in the making, or will we see a crash? And as a lot of questions have come in, which are very valid in the sense that we have yet to see a big improvement in the economy. So the way we look at this is that the markets are now trading at a very small premium to their fair value, not as much as a lot of other indicators like the P multiple or price to book will suggest, but yes, it's at a very small premium. Remember, the biggest component of future returns, however, is going to be driven by the growth in fair value, which we expect it to be reasonably robust. It should outperform the nominal GDP growth, and hence, according to us, the overall returns which equities can generate over the next 3 to 5 years can still be reasonably attractive. We are moderately optimistic on the markets over the medium to long term. And by medium term, we mean 3 years and above, and long term means 5 years and above. So we are optimistic on the markets over that horizon. We think equities will remain the best asset class over the medium to long term. However, an important point to remember is that there is no free lunch. The big risk which you should keep in mind is the interest rates. If the interest rates rise globally and in India on a sustainable basis, that can pose a threat to equity returns. However, that is not yet envisaged, and we do not think it is visible in the near horizon. Last 10 years, we have seen a gradual reduction in the interest rates, and central bankers all around the world have pledged their support to keep the interest rates moderate, and hence we expect status quo, and hence we remain moderately optimistic on equities. In terms of sectors, we like sectors like IT telecom, we like the financial services and banking space, and we are underweight consumer space. There are questions around whether we prefer large cap, mid cap, or small cap. So our preference is actually across the cap curve. All the three capitalizations are equally attractive according to us, and hence we are sort of neutral across the capitalization curve. Since we are moderately optimistic on the markets and markets are not cheap or very expensive, we recommend a SIP over a 12-month period for investors. Now some more details on the product on Union Aggressive Hybrid Fund. So this fund is actually, it intends to invest predominantly in two assets, equities and fixed income. As you are aware, in any battle, a soldier never goes without a sword or a shield. Every soldier goes with a sword and a shield. If a soldier goes only with a sword, he cannot defend himself. And if he goes only with a shield, he cannot attack. And hence, he goes both with a sword and a shield. In financial markets terminology, equity is like a sword. It would help generate superior return for an investor, and the fixed income component is like a shield. It would protect the investors from undue shocks which keep coming. So this fund has the power of both the assets, and hence it reduces volatility and risk. We intend to regularly rebalance the fund, which means, let's say if the equity markets go up substantially, we will sell equity and invest the remaining portion in fixed income. And if the equity markets fall, then we will sell some fixed income and invest in equity, such that our allocation to equity and fixed income remains more or less steady over a period of time. This fund will invest at least 65% of assets in equity, and hence it will enjoy equity taxation, once again, which is a superior taxation for investors. The equity assets will be managed with our proprietary fair value approach, which, as Pradeep highlighted, has given us reasonably good outcomes, and it is very process dependent. The fixed income part of the fund, which Pari will be highlighting shortly, will be managed with keeping safety in mind. So I will now dwell upon how will we be managing the equity portion. So in brief, this fund will invest the equity portion with a multi-cap strategy. So the idea is that we take the power of sector allocation, capitalization, stock selection, and produce alpha using these three levers. Since our current stance is to remain neutral across the capitalization curve, we would invest roughly 2/3 in large cap and 1/3 in small and mid cap for the equity portion. The asset allocation is intended to be at about 70% in equities, plus minus 2%. We would invest in stocks with a growth bias. So there are two types of stocks within our investment process: growth and bargain. We would invest in a blend of both, but the bias will be towards growth stocks. The sector allocation would be in line with the current fund house view. In terms of deployment, there have been questions that when will we deploy the funds raised? Would we time the market, delay the deployment, or hurry up the deployment? Our idea is to deploy the money as soon as we get it, so that we do not take any market calls here. The idea is to remain 70% invested in equity at all points of time, and we would not take much asset allocation calls there. In terms of concentration, our idea is to invest in a portfolio of good quality stocks, which will have approximately 45 to 65 stocks at most points of time. So on the last question, how is this fund different than our balanced advantage fund? So the Union Balanced Advantage Fund is a dynamically asset allocation fund. So it invests in equities between 30% to 80% of the fund assets, and the decision to invest and the proportion to invest in equities is decided by our in-house UMPI model or Union Market Pulse Indicator model. So the Balanced Advantage Fund is a actively managed allocation fund, whereas the fund which we are launching now, which is uh, the aggressive hybrid fund, that fund will have a static allocation to equities, which means at all points of time, it will invest approximately 70% plus minus 2% in equities. So it won't materially increase or decrease allocation to equities at any point of time. And that is the biggest difference between these two funds. With that, I will stop now and hand over to my colleague Parijat Agarwal, who will comment on the strategy about investing in fixed income.
Thank you, Vinay. Pai, you're on mute.
Yeah.
Pai, there are a couple of questions. If you can cover them in your... Okay,
yes,
so we'll have answer
yes.
to answer more questions.
Yes.
One is that, are you looking the interest rate to go up in the near future?
Okay.
Because if interest rates are going to go up, this will have a adverse impact on the fixed income portfolio of this fund.
Okay.
Because 30% will be invested in debt market. And second is the portfolio strategies for this fund, which I'm sure you will be covering. And third is dynamic bond fund. What's your view? So if you can also quickly give a view on corporate bond, dynamic bond, when you're covering this.
Okay.
Yeah? Okay.
Good evening, friends, and thank you, Vinay and Saurabh. See, we have seen that after the pandemic actually hit the the global markets, we have seen across the globe, including our own Reserve Bank of India, has come out to support the financial market with all measures, whether it has been by rate cut, whether it has been by infusing liquidity, or all the other measures which were never done before in the past. So we believe that the RBI and other central bankers will continue to support the financial markets with conventional and unconventional measures going forward. So based on this, the liquidity in the domestic system that we have seen, RBI has infused substantial liquidity in the domestic system. So we believe that and in fact it is coming out of the monetary policy committee members' minutes, that liquidity would remain abundant in the near future. In fact, they go as long as to say that till March 2022, and they will keep the accommodative stance of the monetary policy stance to remain till March 2022. What it means is that RBI is going to keep the rates soft, at least till for the next in the near term, and by March till 2022. Also, we have seen globally that all central bankers have infused substantial liquidity in the system and have supported the bond buying program. What it means is that across the globe, all the central bankers are supporting the extra borrowing by the government across the globe by buying bonds from the market. What it means is that rates are going to remain soft. And also, as Pradeep highlighted in his comment, that we have our own internal models where we forecast interest rates and also look at the growth of the economy by analyzing the high frequency leading indicators. Our model shows that the rates are going to remain soft in the near term, and there is room for further rate cuts to happen. And this rate cut could be another 25 to 50 basis, and it may happen by say March or in the first quarter of next financial year. So still there is room, liquidity is sufficient, and RBI is supporting the financial markets by buying bonds in the market and through other measures to support the market. So our view is very clear: A, rates would remain soft, liquidity would remain abundant. Now, based on these factors, our strategy to manage the 30% of this fund, the hybrid equity fund, as been highlighted, it is more to give stability and support the equity portion of the fund. So the strategy would be to capture the interest rate movements and wherever the spreads are higher, and also keep the the credit quality very high. So we will be investing in AAA rated public sector undertaking bonds in this fund, which will have obviously 3 to 5 year kind of maturity. The idea is that take the risk, but not too much risk. So in terms of the interest rate risk, will remain moderately, will take risk, which is 3 to 5 years. In terms of credit, we are not going to take risk. The idea is to keep the safety in mind. The philosophy is safety, liquidity, and return for the 30% of portfolio part of this fund. So we'll be investing in triple rated PSU bonds. The maturity bucket would be 3 to 5 years, and try to capture if there is any spread compression happening anywhere in the entire curve. We'll try to capture that. Now coming to the the view that if the interest rate goes up, as I mentioned, the macro numbers, the macroeconomic data, both domestic and globally, point towards soft interest rates in the near term. And our model, as I highlighted, is also showing abundant liquidity and softer rates in the near term, and which is also corroborated by MPC minutes. So we do not believe that rates are going to go up in the near term, but yes, obviously rates may go up in the near maybe in a year's time, or maybe after year and a half. So at that point of time, the strategy would be to bring down your interest rate risk. So by investing in a lower maturity bonds, so that we will keep monitoring. And to go forward, this is what to highlight about how we are managing the dynamic bond fund. Dynamic bond fund, corporate bond fund, and medium duration fund. These funds, as I mentioned, our philosophy has remained same. It is about the safety. So we have remained invested in triple rated central government undertaking bonds and government of India securities. And as our view on rates is still very soft, we believe that rates, there is further room for the rates to go down. We have remained on a higher maturity buckets. So for a dynamic bond fund, we are invested in a modified duration of 6 years. For corporate bond, it is close to 2.78 years. And for a modified duration fund, we are at 3.73 years. So that's how it is showing our belief that rates are going to remain soft in all our three funds. And in terms of the credit, it is also visible the way we have constructed the portfolio. So in a similar way, we are going to construct the portfolio for the 30% of this fund. We are going to remain in terms of low credit call, moderate interest rate risk, and liquid portfolio. So that's how we are going to construct the portfolio. So now I would hand over to Saurabh for any questions and answer session.
Thank you, Parijat. I'll quickly read out questions and I'll assign whoever is going to answer questions. So the first question is, Parijat, for you.
Yeah.
What is the state of current yields in the credit market now? And compare with end September, July, and April, any likely impact due to interest waiver and moratorium? This has been asked by Mr. Ganesh Jarkar from Pune.
See, in terms of the credit, still there is a lot of aversion to credit because moratorium is still there, and after that the interest waiver part was there, which is still in the the banks have to write back. So the entire picture is still not very clear. So once this gets over, then we have to see that how many companies actually get affected by that. But as of now, the spreads which we normally see in the market has compressed only for AAA rated PSU bonds. For lower rated bonds, the spreads have not compressed. What it used to be higher, in the last, after the pandemic, it has remained so. So we do not believe that the compression in spreads are going to happen in the near term. Till the economy comes back, on its feet, we do not believe that the credit cycle would, the interest in credit markets would pick up. So that's our view as of now.
Thank you, Pari. The next question is from Mr. Anand from Chennai. Is it good to buy at NFO or later when it becomes ongoing? It all depends on client's liquidity. Whenever the client has got money, we are not going to time the fund, as Vinay said. So even if someone is buying in the like NFO, he'll be investing in fully invested portfolio. We are not going to delay the deployment of the fund. So it all depends on client's liquidity. If the client has money during the NFO, after 1 month, whenever he has liquidity to invest it. The third question is from Mr. Naran PS from Pune. And I will read out all the questions because you asked quite a few questions. I can see it going down till down. So considering 3 to 5 year horizon, which are the funds recommended? Balance advantage fund, hybrid equity fund, and large and mid cap fund. So if you have to choose the 3 funds for 3 to 5 year horizon, Vinay, would you like to take that?
Yeah, actually, all the three are funds from our fund house. They have excellent pedigree, especially the ones which have already launched and have a track record. So actually, the way we have launched funds is that we have launched funds for a specific client need and considering his risk profile. So I would just recommend that all the three funds are great. Depends on the client's risk, his age, and the asset allocation pattern which the partner would want to have. The advisor would recommend. But as far as I'm concerned, all the three funds are excellent funds from our fund house.
Saurabh, can I just add to that?
Please,
Yeah.
go ahead.
So if you look at these three categories, instead of large and mid cap, I would take it as an example of a pure equity fund. Okay, multi cap or a large and mid cap, all the same. And then you have balance advantage fund, and then you have this aggressive hybrid fund, which earlier used to be known as balanced funds. Now, in terms of risk and return, pure equity funds are at the top. They are obviously likely to be more volatile because they are 100% equity, and they are also likely to give you the best returns over a period of time, over 3 to 5 years or longer period. Pure equity funds, whether it's large and mid cap or a small cap or a multi cap, is likely to give you better returns, but it will also be more risky, meaning it will be more volatile. At the other end of the spectrum, you have the balanced advantage fund, which keeps shifting the equity allocation, the unhedged equity allocation between 30 and 80%. So if you take an average equity exposure as something like 50% in that fund, 50 to 60%, that fund is likely to be low on volatility, very low on volatility comparatively, and as a result, it is unlikely. It can, I'm not saying it can't, but number wise, the returns may not be as high as a pure equity fund. Now, the aggressive hybrid fund, okay, falls exactly in the middle of this. So, in terms of risk, if you see, you have balance advantage fund at the bottom. Next level, you have the aggressive hybrid fund, and above that, you have the pure equity fund like a multi-cap or a large and mid-cap or a small cap fund. The reason aggressive hybrid fund is in the middle is that it will always have minimum 65% equity and up to say 80% equity. Average, if you take 70% equity, while a pure equity fund is likely to have 95 to 100% equity, while your balance advantage fund on an average may have 50 to 60% equity. So that gives you the answer. So people who are very conservative, perhaps they should go for balance advantage fund. People who can afford to take a little more risk, meaning they can absorb a little more volatility, they should go for aggressive hybrid fund. And people who are completely okay with any kind of volatility, can invest and forget, can wait for 5 years, 10 years, etc., they should always invest in the pure equity product. So this is where these three products are positioned on the risk return framework. See, if you look at the average returns from these three categories over the last many years, you'll always find that this is a pattern. Pure equity at the top, next the aggressive hybrid, and then you have the balanced advantage fund. Every fund is good, but as Vinay said, as experienced distributors, you would know what is suitable for your investor.
Thank you, Pradeep. You have covered quite a few of the query because queries were between the BAF and this fund. So the next question we have from Shrikant Mathubhai from Bangalore, and outlook on international exposure, and when will Union come out with a fund which has international equity exposure? So Pradeep, would you like to take that?
Yes. We are, what I can say is that, it's something that is uppermost in our mind right now. If there is one product that is uppermost in our mind, it is a fund with international exposure, possibly, fully international exposure type of funds. We are just trying to find out, or figure out the nitty-gritties. There is a wide choice. We are trying to come up with a fund which will be a little different from what is available in the market today. If we can do that with, a good, cost benefit equation and a risk reward ratio. So one of the things, which Srikanji, you can respond in the chat group, and anybody else can respond. I would really appreciate this feedback. We are debating this question internally as to whether we should go for a generic product or a safer product, like say a US market product, something related to S&P or Dow Jones, or say NASDAQ. NASDAQ is a little more risky, or focus only on US European markets and large cap stocks, which one can consider to be safer? Or will there be appetite for a slightly more what is a higher end product, like say a small cap fund, a US small cap fund or a European small cap fund, something like that? Okay, so if any of you has any thoughts on that, because you are in a better position than anybody in the AMC to figure out what will be more acceptable for investors, or what is it that investors are looking for. If you have any thoughts on that, whether there is market for a specialized product, slightly more specialized product, it could be an ESG product. ESG is becoming very popular. So any thoughts on that? If you can post in that Q&A session or mail us separately, I'd be really grateful for that.
Thank you, Pradeep.
आपका जो भी आइडिया है, जो भी सोच है इसके बारे में, इंटरनेशनल मार्केट में कौन सा एक्सपोजर देना चाहिए हमारे इन्वेस्टर्स को, या लार्ज कैप में सिर्फ यूएस मार्केट में देना चाहिए, वो पूरा ग्लोबल इक्विटी में देना चाहिए, और सिर्फ थोड़ा
PSU bonds. So to share with you that we can say that any real estate construction companies are on the the negative list as for us.
Thank you. So Mr. Neeraj Popat from Jamnagar and Rajesh Mansali from Bhuj, we have already answered your questions in the previous question. I will not be taking up them. Vinay, if you can, because there are two more questions which have come in, is that if you can just give a quick take again on the current market valuation, because some people joined in late. So where do we think currently markets are? Are they too expensive? Are they reasonably priced?
Yeah. So the key thing to look at in the market is, I think, valuation based on certain parameters. I think the most popular parameter which almost everyone is looking at today in the market is what is the Sensex P multiple, or what is the Nifty P multiple. And the most popular way of judging whether markets are cheap or expensive is look at what is this P multiple over the last 10 years or 20 years, and then see whether the current multiple is higher or lower. We have actually put down a very detailed research paper highlighting that this method of looking at market valuation is wrong, it is flawed, it will give you wrong impressions about valuations. Why does it happen? Simply just imagine a simple construction of index. Let's say 10 years back, index was heavy in banks. And today the index is heavy on, let's say, FMCG companies. FMCG companies deserve a higher P multiple, 2 or 3 times more multiple than banks. And hence, because of this higher weightage to FMCG companies, today's index is having a higher P multiple than, let's say, past index. The problem with the current methodology is that the investor will deduce that the market is expensive purely looking at the P multiple. And that is the biggest flaw. The way we look at market valuations at Union Mutual Fund is look at fair values for each and every company and then construct the index fair value on a bottom-up basis to arrive at what is the Nifty 50's fair value, which we then generalize for the market. So all our market views are based on this bottom-up arithmetic, which is very extensive at our end. Based on that, what we observe now is that markets are trading at a very small premium to their current fair values. However, market returns are driven by two things. One is what is the premium discount which it trades at. If it is trading at a discount, the future returns will be slightly higher than the fair value growth. And if it is at a premium, the future returns will be slightly lower than the underlying fair value growth. But the dominant factor which will drive investor returns is fair value growth. So now coming back to the core question, where is the markets in terms of valuation? Markets are trading at a very small premium to their current fair value, but this fair value is expected to compound at a very strong pace over the next 5 years, such that equity returns will be much superior than any other asset class which is available for common investors to invest today. And hence we remain moderately optimistic about equities even at current levels.
Thank you, Vinay. And I can do a follow-up question over here. Between the large, mid, and small cap, is there any bias that small cap is looking better or mid cap is looking better for 3 to 5 years, or large cap?
Yeah, so the answer is once again straightforward. We measure the potential returns for each of these categories for all the stocks which we cover. So we cover roughly 80 large caps and roughly 100 small and mid caps. And then we look at what is the potential return for all of these three categories. Based on the current market valuations, the potential return across all these three segments of the market, large cap, mid cap, small cap, is approximately similar. And hence, we are neutral across the capitalization curve and would be deploying across all the three capitalizations.
Thank you, Vinay. So there are 2-3 questions which is on a very short-term view on the market, and I'll just address them. As a fund house, we don't have any view on a short term in the market. So anything less than 1 year, we don't have a view on the market. So we actually never had a view on US election, that what will happen if Trump comes back or Biden comes back. Similarly, right now, we don't have a view on the budget. Okay, what will be the impact of the budget? According to us, our belief is we are able to forecast market over the longer period based on fundamentals. So one thing which you will see in our fund house is we don't have any momentum stocks in our portfolio. We do not have any momentum based technical which we use to decide allocation. We may look at them for different purpose, but they are not part of our process, right? So very clearly, we don't have a view on the shorter term events on the market. Vinay, would you like to add anything on this?
Yes, I would just want to add that it is dangerous for investors' wealth to deploy any money into equities based on short-term views. And I think the events over the last 1 year would have made it amply clear to all investors to not invest in the markets based on short-term events or events which you have no handle on. So for example, a lot of people were talking about March, when the markets tanked in March. If you remember, a lot of people were comparing markets with 1929. There was such a big scare that people were selling out even at that point of time, when it was actually one of the best times. We had highlighted even at that time that the overall impact on the market's fair value was about 10 to 12%, since we were also not completely clear, but it was in this range, but the markets had fallen by 30%. And hence we said, you will make money, significant money over the next 3 years. When will the market recover? We don't know. But definitely you will make a lot of money. The key point which I'm trying to make is, even if you try to do that now, you will maybe you will avoid some volatility, but you will miss out on making a reasonably good outcome over a 3-year period, which is the ultimate objective of investing. So that is what I just want to highlight, that please do not invest based on short-term views, which none of us can have.
Thank you, Vinay. So next question is a common question from Mr. Sandeep Bushetty from Pune and Mr. Narayanan from Pune. So when are we going to be there with our own mobile application and web-based transaction? So before Pradeep, can I ask you to answer the question? And before Pradeep answer, there were other questions on the MFU platform. Yes, we are there on 3 platforms right now, which are commonly used: MFU, BSE, and NSE. Yeah, Pradeep, sir, please.
Yeah, again, this is another thing from a service point of view. A mobile app is something that we have been considering, and my apologies that it has not been there so far. What we wanted to do first was to completely revamp our website. I will be the first person to admit that our website is not really top class. I am personally not very happy about it. A lot of things need to be done with that. Now, our plan was to start that whole thing in the beginning of this financial year in April. Now, as you know, COVID came, and this is one of the few things that took a backseat because we had limited bandwidth and operational ability. So we sort of decided to focus our energy more on the essential things, and the revamping of the website actually took a backseat for some time. But I'm very happy to tell you that we have started the process. We have, I think, actually appointed a consultant, and the whole work has started now. We will try to complete this over the next few months. And once the website is done, then we will work on the mobile app. Now, frankly, why the mobile app, did not get so much of priority also was that we thought for the time being, if anybody wants to use an app, the MyCamps app provides the ability to invest in Union Mutual Fund along with other camps managed funds. So to that extent, the facility on mobile app is already available. But our own app is something that we will take up at the next phase. Our focus right now is on getting a top class website in place.
Thank you, Pradeep. So the next question is, Pradeep, if you can take this question, why Union Mutual Fund is not popular like other AMCs? Because whenever we pitch Union Mutual Fund to our clients, they respond, we are not aware of Union Mutual Fund. What are we doing about this? How are we planning to market, increase our visibility?
Well, I wish we were more popular. And, I was actually counting on all of you to make us more popular. आप सब लोग हमारे बारे में बात नहीं करेगा तो हम कैसे पॉपुलर बनेंगे? तो आप लोग हमारे बारे में बात कीजिए इन्वेस्टर्स के साथ, तो हम अपने आप पॉपुलर हो जाएंगे. But on a more serious note, see, in our business, unfortunately for Union AMC, we lost our initial few years because we were not working with any of you. We were confined only to the Union Bank network. Now that way, what happened is we are very well known within the Union Bank system, but then we were not known outside. Now, in the market today, we are as good as a 3-year-old AMC. Okay, so that is a handicap that we have. We are trying very hard to make up for it. But one thing which we cannot do today, and I don't think any AMC can do today, is to have a massive advertisement campaign just saying that here is Union AMC and building up our brand. Nobody has the balance sheet to do that. You don't see even the larger AMCs doing that. It's very difficult and very, very expensive. Okay, on the one hand, for the AMCs, the margins are coming down thanks to regulatory action, and the ability to spend has been coming down. So we are not going to have any big advertisement campaign like that. One thing which we will do is we will be very active on the digital platforms. So this year, if you have noticed, we are already more visible on various digital media, and increasingly we will invest more, and we will try to be visible more and more on digital media, because we think that more of the investors also these days are on digital media. So I'm afraid we will not be taking out advertisements on Times of India, but we will try to be more visible on various digital media wherever we can, whether it's Value Research or Cafe Mutual or Wealth Forum, a number of places that we will do. Secondly, our performance should speak for itself, which is happening today. Now, one of the things we can't advertise about it, but the fact is that many of you would have noticed that our ratings on Value Research have been improving. Okay, now we have a number of funds which are 3-star rated purely based on last 3 years track record. This will improve. We will have a number of funds which are 5-star rated. But then Value Research is only a return based rating. It is not. It doesn't consider the risk part of it. Now there is a CRISIL CPR rating which is based on a risk adjusted return parameter. They look at a number of risk factors also. There we have a number of funds which are in CPR2, which is the second highest rating by CRISIL. Okay, so we are becoming more visible on all those platforms and forums, and I'm hoping that this will get noticed by investors also as we go along. Okay, beyond this, we will really seek your support to get us known better and make us more popular. Anything else that you think we should do, always we'll be very happy to consider that.
Thank you, Pradeep. Vinay, the next question, if you can take it up, is on the view on gold. And the second question is that there are many thematic funds and sector funds being launched. We don't see any sector fund coming from Union Mutual Fund. So how do you differentiate your NFO? And what's your view on the banking and financial sector fund?
Okay, so there are 3 questions. So first on gold. See, basically gold is an asset which doesn't generate any returns, but the price is dependent on the level of fear in the system, how much scared the investors are regarding the US dollar. So if investors are more worried about about US dollar as a currency, they increase their exposure to gold and the prices go up, and vice versa. So gold is a great hedge against something worse happening in the global financial system, and hence it's a good tool for diversification as an asset class. But beyond that, we cannot estimate the fair value of gold. It is difficult to judge what would be the demand for gold, simply because there are less productive uses of gold. And hence, it is while it is a good tool for diversification of assets, we would hesitate in putting up any views on gold as to positive or negative on that asset class. Your second question was on why this NFO or why Union Hybrid Fund and why not some other sector or thematic product. I think as Pradeep highlighted, we normally launch a fund where we think investors can make money. According to us, this product has a fairly well balanced approach towards investing. It invests in both equity and fixed income, reduces investors' risk, and at the same point of time has a promise to has a potential to deliver reasonably good returns over the medium to long term. We do not see that in too many thematic products, which we think may be very risky for the investors at this point of time. We will come back to investors when we think there are good themes around in the market for investors to make money, or there are certain sector products for investors to make money. So we have not closed our eyes there, but yes, this fund has a priority in terms of whether it can make investors good returns, and hence we have launched this product.
If I could add to that, Vinay, So we are also what do you say, conceptually not in favor of open-ended sector or thematic funds as a fund house. I'll tell you the reason. Okay, there is no sector that runs forever. See, the equity market runs forever, it's a perpetual thing. Okay, but no sector runs forever. I don't have to educate you, but you all know what has happened to whether it's IT fund, pharma fund, infra fund, banking fund. There are a number of sector and thematic funds that have been launched, and I'm sure almost all of them, would have done very well in the beginning. Now the problem is that we as mutual funds, we are very good at launching a fund when it's in momentum, when it's running. Okay, uh, when it's not running anyway, nobody's going to buy those funds. That's a market reality. So we launch a sector fund when we believe the theme is good, and you will invest and it will do well for some time. And I have not come across any fund house so far coming and telling its investors that the time for this sector is over, this story is over, we are winding up the fund. You gave us 10 rupees, it's 20 rupees now, take your money, this story over, we'll wait for the next story. Nobody does that. Invariably that sector story will play out, it will go down, NAV will fall, and poor retail investors will stay with the fund and will be very unhappy. This is the typical story that has played out on almost every sector fund or thematic fund. So conceptually, we are not in favor of launching such funds. We will only launch such funds when we think we can build in a profit booking mechanism into this. So many of you would remember, at least some of you would recall, that we had launched 2 trigger funds in the past. So these were closed-end funds, 3-year closed-end funds. But we said whenever the NAV goes up by 30%, we will compulsorily wind up the fund and give the money back. And the first time we gave the money back with 30% return in 9 months' time. And the second time it took more than 2 years. But that if that kind of option is there, we might consider a sector or a thematic fund, because then we can be confident that investors will have a positive experience and they are likely to make money. Otherwise, seeing the experience of so many sector funds in the market, we are not really enthused about launching such funds. I'm not saying never, because never is a very strong term. I never take such a hard stance, but this is one of the areas in which I have a fairly firm view. Unless we are confident that we can find a way for everyone to make money, we'll not do it.
Thank you, Pradeep. Vinay, if you can quickly, someone has asked, there are 3-4 questions on the banking and financial sector right now, because I think people are asking questions because the sector has not done so well compared to other sectors. And does it make sense to do some allocation to that kind of fund right now?
So I would recommend that the investor should invest in multi-cap strategies, which include multi-cap funds, or even the balance fund, or our hybrid fund, which has a multi-cap portion. Because as Pradeep just now highlighted, that there is no sector which always remains in good or bad. There are times when some sectors are good, there are times when some sectors are bad in terms of their valuations or outlook, but it keeps changing. Our current view is neutral to slightly positive on the banking and financial services sector, but and hence we are in our portfolios reasonably good, well exposed to good quality banks and financial services. But as I said, investors should opt for more multi-cap products which are sector agnostic, rather than going in for sector products, which where investors will need to time themselves, which can be difficult.
Thank you, Vinay. So next question is from Mr. Sadab Khan from Jaunpur. What is the ratio of debt and equity for this NFO? So 70% would be equity, 30% would be debt, and we would be doing a rebalancing at every 2%. So for example, if market goes down and the equity allocation, because market has gone down, comes down to 68 or below, we will buy more and make it 70. And vice versa. If market goes up, it crosses 2% limit, that is 72 and above, we will rebalance it to 70. That's the current strategy that we have. This will not be a dynamically managed equity portion. Even though our SIT says 65 to 80, right now we are considering at 70-30. Is that right, Vinay?
Yes, absolutely. We would want to make it static because that is the core difference between this product and the balanced advantage fund. So if one were to just simply imagine the difference between this product and the balanced advantage fund is active asset allocation. Union hybrid equity fund is static asset allocation, which means equity at 70 and 32 fixed income.
So next question is from Mr. Raghavendra S from Hyderabad. Are we going to change our multi-cap to flexi-cap? Pradeep, if you can answer that, please.
Yes, we will be migrating our multi-cap fund to flexi-cap fund after following all the formalities, getting SEBI approval, exit option, etc. We'll be doing that as soon as possible. The process has started.
So thank you, and I think I have covered most of the question. And thanks once again for everyone for joining in the call. If I'll try to sum up the equity and the debt view. So clearly, our fund house view is that market is not very expensive. It is trading at a slight premium to the fair value. And if someone coming into equity market right now, his returns for next 3 to 5 years will be very close to the fair value growth. In terms of cap, all three caps are equally attractive. That means as a fund house, we don't have a bias towards a large cap, mid cap, or a small cap. All the three caps are equally attractive to us. In terms of sector overweight, we are currently overweight on IT, pharma, and telecom. We are neutral on financials, and we are underweight on discretionary, consumer discretionary, and consumer staples. The portfolio for this fund would be run like a multi-cap. The difference between the multi-cap fund and this fund will be number of stocks. Our multi-cap fund currently has close to 60 stocks. This fund will be having close to 45 to 50 stocks. In terms of allocation, right now the multi-cap fund is 70% into large cap and 30% into small mid cap. This fund will also endeavor to have 70% in large cap and 30% in small mid cap. In terms of fixed income, we don't see interest rate going up for foreseeable future. However, we are very cautious on the credit risk. So as a fund house, right now, we don't think the risk reward ratio is favorable to increase the credit risk in the portfolio, but we are bullish on the interest rates coming down in the near future, and our portfolios are slightly long on maturity, keeping that in mind. The fixed income portfolio for this fund will also be built on very highly rated, good quality AAA papers, mostly PSU and the corporate papers over here. So which is the way the portfolio will be constructed on this side. Once again, thank you everyone for joining in the call, and our team will be in touch with you in case you require support for this for this NFO or any other ongoing scheme. Thank you for joining in.
Thank you.
Thank you.
Thank you, everyone.
Thank you.
Bye-bye.
Bye.